The central bank has published a research paper on the effectiveness of imposing caps on mortgage loans. Next week it will publish proposals for lenders. The context, according to the central bank, is the potential risk to new lending in the presence of volatile property prices. The bank's economists found that limits on high loan-to-value lending will improve bank resilience by reducing losses in the event of a default. Specifically, the bank drew attention to the fact that over 50% of new lending last year was based on loans of above 80% of the property's value. And in the past, higher loan values have led to higher default rates. The central bank is clearly worried that galloping property prices and bigger loans could be storing up the same kind of problems for our banks, which spectacularly exploded in the crash. Putting a cap on lending would be a bold move for an institution often criticised in the past for not taking away the punch bowl when the party raged on. House prices in Dublin have risen by 25% in the past year, while prices outside Dublin are rising at just 5.6%. The average asking price of a three-bed semi in the capital is now €260,000. Earlier this week, stockbrokers Davy warned that property here was no longer cheap.
We're at that point in the cycle now, which is sort of a classic point where lending standards get to be relaxed. House prices rise, there's a lack of supply, and that means first-time buyers particularly want to overextend themselves, borrow ever more, greater levels of debt to finance house purchases, and ultimately that just ends up in house price inflation.
But at this uncertain time, prospective first-time buyers are also being squeezed by rising rents.
The issue is that a lot of first-time buyers, just because of the age they are, the jobs that they work, asking them to save up 20% of a house price at a time where taxation and money going out of your income is around 50%, it's just not that realistic. But the whole solution is to create more cheaper housing, not to cap mortgages.
Increasing supply in the right places is, of course, the solution, just as it was hailed as the solution during the boom. Problem is, a lot of damage can be done in the meantime.
The central bank's research yesterday showed very clearly that those people who took out higher loan-to-income multiples, higher loan-to-value mortgages, those are the people who are now defaulting on their mortgages. So it's proven to be a very good indicator in the past of the kind of people who are going to end up in trouble. So therefore I think it's a pretty good metric to use to try to stop those defaults happening in the future.
They're a crude instrument, they are effective but very blunt, and it wrecks a lot of good things in a market, along with getting rid of some of the risk of the bad things. But the issue in Ireland is the credit machine is broken, it's not even up and running, and they're talking about trying to tame it.
Details announced today on reducing the percentage of any development which must be given over to social housing and a levy on unused sites may encourage more construction activity. But the big beast of credit, which has cast such a long shadow over the economy, is still the trickiest thing to get right.